Good afternoon. Myself Dinesh from Fundamental Research. I will be talking on the Q2 earnings review. The Q2 earnings were slightly higher than our estimates, and in this quarter, the positive surprises were, there were more positive surprises compared to the negative surprises. So coming to the Sensex earnings, on aggregate basis, the Sensex earnings grew by 4.3% YOY, which I said was slightly higher than our estimate. Excluding oil companies, the Sensex earnings growth was about 12.9% YOY. The growth in the Sensex earnings was primarily driven by private sector banks, pharma and FMCG companies. However, the sectors like metal, power and telecommunications largely disappointed on earnings front. Looking at the breadth of the Sensex earnings, the breadth actually improved in this quarter. Though 13 out of 30 companies showed a decline in the YOY earnings, but the extent of surprise was much lower compared to the previous quarters. Companies like HCL Tech, Sun Pharma, Cipla, Maruti, NTPC, etc. Has delivered positive surprises, whereas companies like Tata Steel, SAIL, Tata Power and Bharti Airtel delivered negative surprises. Now, looking at the revenue picture, the revenue growth has turned sluggish as expected. For the Sensex companies, the revenues grew by 11.7%, which was in line with our estimates, which is also the lowest growth in past several quarters. The weak macro environment and weaker economic growth is taking toll on the revenue growth of companies. In this quarter, the revenue growth was mainly driven by IT companies and pharma companies due to the rupee depreciation benefit, and also in this quarter, private sector banks also posted healthy performance as their net interest income grew by almost 25%. However, the SBI largely disappointed on the top line growth as its margin declined quite steeply in this quarter. The margin continues to decline. In Q2, the EBITDA margin of Sensex companies came down to 17.2% compared to about 19.9% in Q2FY13. The maximum stress in margins was seen across oil and gas segment, telecom segment, and Reliance Industries. However, the EBITDA margin improved slightly for pharma and IT companies. Now, looking at the coming to the outlook on earnings, we believe that the earnings growth is holding up despite the tough macro environment. Also, in this quarter, as I said, that the positive surprises were more compared to the negative surprises. But the growth in earnings is so far limited to the Sensex companies, whereas for the broader market, many mid-sized companies still are struggling with difficult business conditions. However, the good news is that the incremental downgrades are coming down, and the downgrades are largely confined to the troubled sectors. The consensus expectation of earnings growth of 8 to 10% for FY13 and about 14% growth for FY14 looks quite reasonable. However, any upgrade would depend upon the extent of monetary easing by RBI and the trend in the commodity prices.